Next, let me turn to other revenue options. I think several members touched on this. They asked if we can do more on other revenue options, especially income and wealth taxes. And in particular, the WP offered a range of revenue options as alternatives to the GST increase. The short answer is we cannot just ignore consumption taxes and put the entire burden on income and wealth taxes. We need a good mix of all three types of taxes: income-based, asset-based, and consumption-based. This is how we ensure that our revenue base remains diversified and resilient while achieving its objectives of being fair and progressive. In fact, all jurisdictions rely on these three forms of taxation, and the OECD jurisdictions have much higher VAT rates on our GST than Singapore. Much higher, all in double digits. But let me go through the revenue options one by one. Let me touch first on corporate income taxes, or CIT. As I said in the budget speech, it is hard to be definitive at this juncture about the overall tax revenue impact from both Pillars 1 and Pillars 1 and 2 of BEPS 2.0. Will the implementation of the minimum effective tax rate, or METR, bring us more tax revenue? Yes, the short answer is yes. Mathematically, it has to be so if nothing else changes. In other words, if we have the same volume of investments and business activities in Singapore, even as taxes go up with the METR, yes, we will collect more. But that is a very big if. It is hard to estimate with any confidence whether or how much net tax revenue we can collect from both Pillars 1 and 2. The eventual impact cannot be ascertained by a simple static analysis, and it will also depend on how governments and companies will respond post-BEPS 2.0. BEPS 2.0 represents a fundamental change in the competitive environment for Singapore. Hitherto, smaller economies like us could rely on tax incentives, not just non-tax factors, to make up for our inherent disadvantages like limited land and labor force. But this is no longer as effective post-BEPS 2.0. Companies will review their existing and new investments. Governments will also seek to compete via non-tax investment promotion in order to recover from the pandemic and to make up for what they can no longer do through tax incentives. Our engagement with investors is already revealing this. Next, personal income tax, or PIT. Currently, the top 10% of taxpayers who pay PIT already account for about 80% of our total PIT revenue. With the top marginal personal income tax rate at 24%, we will be higher than the 17% top rate of Hong Kong and closer to the Asian average top marginal personal income tax rate of 28%. There is a limit to how much we can increase PIT rates for the top income brackets without touching the PIT rates for the income brackets below it. If we were to keep GST at 7% and raise the same amount of revenue through PIT, the top marginal rate would have to go up from 22% to 42%. And that would apply to everyone with chargeable income of $320,000 or more. And that is assuming the tax base remains unchanged. But we all know this sharp increase is untenable and will badly damage our competitiveness. Investments and jobs for everyone, including lower and middle income earners, will be impacted, not just taxes. So to raise the same amount as a GST increase through higher PIT, in reality, we would have to raise the PIT rates for a broader group of income earners, including the middle and upper middle income earners. Next, wealth taxes. Mr. Louis Chua said we should do more on this front, especially on property taxes. On the other hand, several members like Mr. Chong Ki-hiong raised concerns that increased property taxes will impact many retirees and senior owners of private residential properties. So again, we have to find a balance. If we want to raise enough tax revenue from property tax to eliminate the need for a GST rate increase, what would we have to do? Well, we would have to tax all non-owner occupied residential properties at a significantly higher rate. Let's say we tax all non-owner occupied residential properties at a flat 36%. This would still not be enough because the number of non-owner occupied residential properties is considerably less than that of owner-occupied residential properties. So, we will need to raise property tax rates significantly for owner-occupied residential properties, including for HDB flats. In fact, I'm somewhat surprised that Mr. Chua characterized our moves on property tax rates as tokenism. $380 million more per year, and he says it's tokenism. Well, currently our total property tax revenue from all residential properties is about $1 billion. Currently, to raise another $1 billion from just property tax alone, property tax rates may very well need to be doubled across the board. I suppose that's what the Workers' Party is proposing. There were other suggestions for wealth-related taxes. For example, Mr. Saktiandi suggested estate duty. We did away with this in 2008 because it did not achieve the social equity outcomes we had hoped for. In the end, middle and upper middle income individuals were disproportionately affected by estate duties compared to the wealthy who were able to find ways to avoid through tax planning. And besides us, the jurisdictions that have repealed the estate duties, like Hong Kong, Malaysia, and New Zealand, have not reinstated it either. There were also suggestions to tax capital gains or dividend income. But remember, jurisdictions in the region do not tax capital gains or dividends. And if we were to do so, that can very easily hurt our competitiveness. It will impact jobs and Singaporeans. Associate Professor James Lim and Mr. Louis Chua suggested we introduce a net wealth tax, and they estimated it could yield about $1.2 billion annually. As much as we would like to tax the net wealth of individuals in theory, I have explained it is very challenging to do this in practice. What happened with estate duties could very well happen here. Many forms of wealth are mobile, and as long as there are differences in wealth taxes across jurisdictions, wealth can and will move. That's why many jurisdictions have already abolished their net wealth taxes. In fact, only 3 OECD jurisdictions now have a net wealth tax. And then, what about the so-called externality taxes, such as sin taxes and carbon tax, as suggested by Associate Professor James Lim? I'm surprised he raised this in the first place as a means of generating revenue. Tobacco taxes, for example, is a regressive tax. The lower income groups pay a bigger share of it. The Workers' Party had expressed such strong concerns about the regressivity of the GST, but does not appear to be the least concerned about regressivity here. Why the double standard? In any case, we do not levy sin taxes for purposes of generating revenue, but for deterring consumption, and we will review and adjust these taxes from time to time.